How does delta affect LEAPS options? Have you ever wondered how delta impacts your long-term equity anticipation securities options? Understanding this can make a big difference in your trading strategy. Delta is a key measure in options trading. It tells you how much an options price will change when the underlying stock price changes by $1. For LEAPS, which are options that last longer than 1 year, delta is especially important. Let's break it down. When you see a delta of 0.50, it means that for every $1 change in the stock price, the LEAPS option price will change by about 50 cents. Since each option typically covers 100 shares, that means the option behaves like owning 50 shares of the stock. If the delta is 1.00, the LEAPS option moves dollar for dollar with the stock, acting like owning 100 shares. This makes delta a useful tool for understanding how much exposure you have to the stock. Now, delta isn't fixed. It changes based on the stock price and as time goes by. For LEAPS, if the option is out of the money, the delta is usually lower. But as the stock price gets closer to the strike price, the delta can increase. If you have a deep into money LEAPS call, it might have a delta of around 0.80 or higher. This means it behaves almost like the stock itself. On the other hand, if the LEAPS option is far out of the money, it will have a low delta, showing less sensitivity to stock price changes. The impact of delta on pricing and strategy is significant. LEAPS options generally have a more stable delta compared to shorter-term options. They also experience slower time decay. This stability makes them appealing for traders who want stock-like exposure without tying up too much capital. If you choose LEAPS with a higher delta, you can expect your position to track the stock price closely. This can be a smart move if you believe the stock will rise. On the flip side, lower delta LEAPS are cheaper but carry more risk. They might expire worthless if the stock doesn't move significantly. However, if the stock does move, they can offer higher percentage returns. Traders often use LEAPS calls with a delta around 0.80 or higher to mimic owning the stock. This strategy allows them to benefit from price appreciation while limiting their risk to the premium paid. For those looking to speculate, buying LEAPS with low delta can be a way to bet on large stock movements. Even if the stock doesn't reach the strike price, the option can gain value if the stock price rises and volatility increases. Investors holding stock positions may also use LEAPS puts with negative delta to protect against downside risk over a longer period. In summary, delta affects LEAPS options by showing their sensitivity to stock price changes and serving as a measure of stock equivalent exposure. High delta LEAPS act more like the underlying stock, providing stable price movement. In contrast, low delta LEAPS offer speculative opportunities with higher risk and potential rewards. Understanding delta can help you choose the right LEAPS strike and strategy based on your market outlook and risk tolerance.